The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
With so many people living longer, the fear of outliving your money becomes a reality for many of us. Will I be a financial burden? Will I outlive my money? How will I be remembered? My name is Neil Himmelstein, president of Main Street Planning Group. Please contact me by visiting mainstreetplanninggroup.com. That's mainstreetplanninggroup.com, or call 631-647-4694. I will introduce you to strategies that will guarantee you will not outlive your money, that can guarantee you will not be a burden on your loved ones. Through a collaborative approach, we will uncover solutions that offer tax-efficient strategies, lifetime income, and legacy planning, choice, organization, direction, and education. That is the code we stand behind. Contact mainstreetplanninggroup.com. That's mainstreetplanninggroup.com, or call 631-647-4694. And listen to me every Friday at 3 p.m. as I host the Main Street Code for Financial Success, right here on 103.9 LI News Radio. Good afternoon, everybody. Welcome to the Main Street Code for your financial success. I'm your host, Neil Himmelstein. If you want to reach me, you can call me at 631-647-4694 or hit me on the mainstreetcode.com. I'm always available. I have YouTube videos there, things to look at, things to talk about. We need to protect your future. That's what we do. When we talk about our code, we talk about choice, organization, direction, and education, or I'm still thinking about replacing that word choice with communication. Communication is key. You want to talk to your family members, and you want to put a financial team together that can help you with not only your investments, your insurance, your taxes, and any legal work you do. It all got to work together for you in your plan. And today, I'm very fortunate to have with me as my guest and my friend, Scott Cheslowitz, who has a show. Scott, would you introduce yourself, please?
Hello, everybody. Scott Cheslowitz here. My show is called Tax Talk. And Neil, you're wonderful. I always enjoy when we get together. We always smile a lot. You know, we're like kindred spirits.
We are. You know, when I first met you, you started telling me my own jokes. And so I said, you're the first accountant I ever met who told me my own jokes. This is not good.
Because I believe in quality of life. I say it all the time.
I know you do.
It's up to you to smile. We can look up or look down. But that's enough of my philosophy for
No, that's all, it's all good. It's all good. I always enjoy having shows with you, Scott, and I enjoy just sitting and having lunch with you. We always have a good time.
We do, especially when you pay.
Yeah, and sometimes we even talk business. That's the scary part.
Yes.
You know, one of the things I'm amazed about is Scott's knowledge and breadth of my products in offense of, you know, I'm an insurance wholesaler, but I also advise, you know, individuals on their insurance questions, and accountants and attorneys and other advisors across the country call me all the time with questions. And I recently had one of my advisors call me. I knew the answer right away, even though it was a legal question. And I sat with lunch with Scott and another attorney, and of course Scott knew the answer immediately. It blew me away because it's one of these war stories, but it's true. I talk a lot about annuities. And why am I talking about annuities? Annuities are a wonderful thing right now because we're in a situation where we need to keep up with inflation. And you can't keep up with inflation with money sitting in the bank at 1%, 2%, or a 3% CD because you're taxed on it every year, right, Scott?
Absolutely. So you're not even getting that 1%.
Right.
You're getting a percentage of 1%. And you're not keeping up with inflation, as you pointed out, Neil. So you're losing more than even if you just got that 1%.
Right. And the value of an annuity is it's tax deferred. So even in a fixed annuity, I mean, we represent fixed annuities and we do index. We do a lot of annuity business. But we're paying as high as 4% right now. I mean, it's crazy. And you're not getting that at any bank, at any CD. I haven't seen them anywhere. And there's no taxes on that until you touch the money.
Right.
So when you compound that 4% over 5 years, I did a comparison. It's insane, you know, and there's no charge to go into a fixed annuity. There's no charge. Everybody says, oh, they're expensive. Yes, I get paid a commission. That's part of my job. I don't, but it doesn't come from you. It comes from the insurance carrier.
Neil, I'd like to mention this. People are so hung up on commissions and fees. I'm a consumer also. If those commissions and fees are giving you a net benefit, then that's all that counts.
Right. So, but nobody ever asks what the banks are making on your money. And I point this out because a bank makes anywhere from 20 to 25% on your money when you put it in their account. So here's an example. You give them $100,000, right? And you put it in a CD or you put it in a savings account. What does that bank do with your money? It loans it out. What do banks love to do? They love credit cards. Why? They're charging 20, 30%. It's insane. We know how bad credit cards are and how bad they can get, but banks love them.
Right. And they love mortgages, where they're charging much more interest than what they're paying. Right? From the Fed.
Yes, but so let's say a bank makes 20% on your $100,000, just 20. I think they make more, actually.
Yeah, they do.
That's why they put buildings everywhere. It's amazing. So they make 20% of your money. So you put in $100,000 and they're giving you a whopping 1%. And at the end of 5 years, you got $105,000. I'm sorry, you don't even have $105,000 because they're taking taxes out every year. So maybe you have $104,000. Yeah. Okay? Mm-hmm. Meanwhile, that bank has doubled its money, 20% a year. They've got like $200,000 of your money. But you know what? It's really nice. They give you a lollipop when you go in there.
Yeah, that's why I go, to be honest with you. Sometimes I don't even go to do a transaction. I just go take the lolly and run.
But since COVID, they're not even doing lollipops anymore. They used to give you a gift. They used to give you a toaster. Remember? I'm saying my age, but, they used to give a pen, a toaster. Now a lollipop, and it's not even a good lollipop. They give you the crappy lollipop.
What kills me is COVID's no excuse because the lollipops were wrapped.
I know. It's no good anymore. So anyhow, but it is good. Listen, I'm not saying banks are bad. It's good to have that relationship. You need banks to do transactions and other things, but to hold your money, they love you when they hold your money. They love to hold your money. That's how they make money.
Yeah.
Holding your money. So if you want that nice handshake with a lot, you know what? If you meet Scott or I, we'll give you a lollipop also, and we're going to give you great advice, and we're going to make you a ton more money. And we're going to help you save money in taxes in doing things safely. I'm not an investment advisor. I'm not talking about this stock or that stock and this goes up and this goes down. I sleep at night.
Yeah.
You know,
Neil, unfortunately, people are so wrapped up in this busy world, and I understand it. They don't take the necessary extra steps to do planning and to save tax dollars. So they do what's easy, a lot of people. And unfortunately, they're costing themselves tremendously. Now, this sounds self-serving, but I couldn't say this unless I had happy clients. And you couldn't say what you say unless you have clients that love you also.
Right. Now, annuities have a tax deferral feature, but when you take the money out, it's actually what they call FIFO or LIFO, or they tax part of it, but not all of it. And there's strategies of taking money out of annuity, just like there's strategies of putting money into annuity. There's strategies of taking it out so that you don't get the full tax burden. Mm-hmm. You pay the growth, but you don't pay any tax on your principal. Right. So you can either what we call annuitize it out, like those immediate annuities and pensions I've been talking about, or you can take a regular income stream out in a favorable way. It's all part of the planning after the fact. And I ran into a client the other day, not a client, a woman bought a big annuity through one of my agents, and she sat with an attorney. And we talked about this before at lunch with an attorney and you, and I was great because I'm sitting with this great attorney who's been on my show and a fantastic tax specialist with an annuity question, which I already knew the answer, but I wanted to hear their knowledge. And they were both so right on it, and I couldn't believe it. So somebody went to an attorney. Now, when you're getting an estate done, or you're getting your wills in your estates, you don't want to go to any attorney. Just like if you're getting your taxes done, you don't necessarily want to go to H&R Block. You want to go to somebody like Scott, who's going to look into all your stuff, not just give you a generic, put in box A, C, D. No, this is where the computers are screwed up, okay? My kids got screwed up by doing that. Oh, we're going to do our own this year. No. And every time it's like, well, I want to go back to your accountant because I got more money back. Or, because they're talking to you. They're looking at you. They're looking at your situation.
And it's not just about doing a tax return. It's talking about your future. It's talking about education planning for your children, your retirement. How many people have not saved adequately for retirement?
Scott, you're so right. Anyhow, you're listening to the Main Street Code for Financial Success. This is Neil Himmelstein, themainstreetcode.com, 631-647-4694. And my guest today is Scott Cheslowitz, who you can hear when, Scott?
Wednesday nights from 5 to 5:30. And you can contact me at 516-773-3200.
And we'll be right back. Welcome back to the Main Street Code for your financial success. This is Neil Himmelstein. You know where to reach me, and I'm here every Friday at 3 o'clock, and I have as my guest today Scott Cheslowitz, who has his show on Wednesday at 5 o'clock, Tax Talk. And we like talk taxes and insurance. They all kind of go hand in hand. And before the break, we were discussing how annuities are taxed. So we talked about tax deferral, so you don't pay any taxes, that money's growing. But then when you take the money out, there's a taxation. And usually, if you plan properly, it's not all taxed, where unlike a savings account or a CD or any other vehicle, you're taxed all the time, every year. So tax deferral is a great thing, but annuities may or may not be the best thing to accumulate and not distribute because there could be a tax at death.
Neil, let me just say, I had a situation where a client did not pay attention to their document. They broke their annuity before they were 59 and a half.
Oh, that's a troublesome one.
Found out later, and they were subject to the 10% penalty.
Correct.
What a shame. You people don't just buy something and put it away. You have advisors that you can trust, not somebody who's just there to sell you something once, somebody you don't mind picking up the phone and calling, like Neil Himmelstein.
You know, that's a good point. So annuities, when you set them up, usually have a time period, not unlike a CD, but let's say they have what they have is a surrender period. So they may be a 5-year or 7-year. And, a lot of times people want shorter surrender periods, but they still have liquidity in most annuities where you can take maybe up to 10% out a year. But you have to be cognizant because annuities were designed as extra retirement vehicles above IRAs and 401ks. So they're subject to the 59.5 rule, where you can't touch them to 59.5 or you're subject to a 10% penalty. And if you need the money next year or something, and you need more than 10%, you could pay a penalty on your money. So when you're doing your planning, a good planner is going to ask your time horizon. When do you need this money? Do you have enough money for emergencies? And we have to do quite a bit, especially in the state of New York, of suitability review and reviewing that information. So somebody glosses over that stuff and is not doing it, that's not the advisor for you. Mm-hmm. You want to find out your time horizon. When are you going to need this money? Why are you going to need this money? Maybe you're not going to need it for a long time. I want this money to be left behind to my next of kin. So I just don't want to pay taxes on it. I want to leave it left behind. But we find a lot of times we have 85, 90-year-olds, they have to start taking income from their annuity. They've never taken it, and they're freaking out because they got to take income, and they know they got to pay tax on it. But usually at that age, your tax bracket isn't as high as maybe your 60-year-old that you want to leave the money to, or your 40-year-old, or your disabled child, or something else. So we do a lot of income strategies to maybe deplete the annuity, and then sometimes you may want to defer it. But I just ran into a situation the other day, and I keep trying to get back to it. I just keep forgetting to get back to it. But somebody said, one of the things when you pass away with an annuity, it goes to your spouse, that's fine, but to the next of kin, it's taxable. Any of the gain is taxable to the next of kin, and that tax has to be paid within 9 months. So if you're going to leave this annuity behind, this is one of the things you have to think about if you haven't taken any money from your annuity, that you may create taxation
Well, yeah.
to the next generation without meaning to, because you wanted to leave that money behind.
You will create taxation because there is an income buildup, and they will be taxed at ordinary rates. And there's also the potential estate tax issue with the right. Estates usually need to be filed within 9 months of date of death. They can get a 6-month extension, but it's not an extension of time to pay. It's an extension of time to file. So, again, it's facts and circumstances with each individual situation.
Now, you may, I'm sure you know this, Scott, an annuity really has 3 parts to the contract. You have the owner, you have the annuitant, and you have the beneficiary.
Yeah.
And they could be 3 separate parties. And you could have a company own an annuity, you can have an individual own an annuity, you can have a trust own an annuity. And the problem is, if it's not an individual owning the annuity, you lose that tax deferral. You're going to get a tax statement every year. So there are situations where we do that. But we had a situation recently where someone was doing their will and their estate planning, a woman in her 70s who just bought an annuity, nice size annuity, moderate size estate.
Mm-hmm.
And the attorney, I don't know who the attorney is, but they were not a specialist, obviously, suggested she put the annuity inside her trust. So let's say she went ahead and did this, and they didn't call me or call you or call the right attorney.
Yeah.
And she put it inside the trust. What would happen with that annuity?
First of all, once you change the owner, you have a problem, right?
Well, the cost basis, she just bought this annuity.
Okay, so right.
But
so
if she hadn't,
if
it was 10 years old, now that you switch it from one owner to another, there's a tax there.
There's a tax right there, and maybe a 10% penalty,
right?
Depending on the age of the individual.
That's not the situation there.
But now you're looking at immediate taxation of the income, opposed to the deferral.
Correct.
So people, just because you get the advice from an attorney or even an accountant, you should still talk to your capable insurance agent like Neil, who is going to say, because this is his lane, it's not my lane. He's going to say, you're creating a problem. You can't do this. You need all the minds. You need all the people at the table.
Right. And the other thing, and listen, there's good accountants, there's bad accountants, there's good insurance guys, bad accountants, there's bad attorneys, there's good attorneys.
Right.
But there's also specialists. And people develop niches, and they're really good. Scott's, listen, I can rely on Scott for company stuff, for employees, or he's a vast knowledge.
Thank you.
And he's smart enough, as am I, if he doesn't know something, to reach out to another professional that has a specialty in that area.
Right.
And you have too many people who are generalists.
Mm-hmm.
You have accountants that want to do investments, and they want to do insurance, and no, you need specialists.
And you need people that care. You need professionals that care enough to want to get you the right answer.
Right. And just because someone's an attorney doesn't mean they know how to do a will.
Right.
And I just had another situation. We talk about war stories, and this is from a listener here who, listener here, she came here, and we work very closely with her, and she's, I think, in hospice right now, and I hope everything's well. And I did some planning with her, and this was recent. But her relative called me and said, "Oh, everything's a mess. We don't know where she didn't complete her will. She didn't complete this. She didn't do this." He says, "Can you tell me where her investments are?" And I had said, "Do you have power of attorney?" "Oh, yeah, I have power of attorney. I have guardianship." I said, "I want my attorney to look at the power of attorney and the guardianship papers, and before I can release any information to you. Mm-hmm. I'm protecting my client."
Yeah.
Okay? Because, I heard your name before, but I need to know legally before I can expose any. I protect everyone's privacy. That's not only the law, that's my credo and everything else.
Huge.
So at the end of the day, then this is the story, and this is true, she went online and did her own power of attorney and did not do a guardianship and did not do the right thing. And she said her son was an attorney, but he was away. And I haven't heard from her since, but I had her call the same attorney we sat with, and she said, this is garbage. This is not legit.
It may be outdated. It may be right.
Again,
like
because they didn't go to the right people.
Yes.
So and they tried to do it themselves. They tried to do it in their taxes themselves. You can't do all this yourself. Nobody has the knowledge to do it all themselves, and you're going to mess yourself up to a horrible situation. You're listening to the Main Street Code for Financial Success. You can reach me at themainstreetcode.com or call me at 631-647-4694. This is Neil Himmelstein. We reach anytime. And my lovely guest, Scott, how can I get a hold of you?
Scott Cheslowitz, www.rothenbergpeters.com, 516-773-3200. Neil, I love being on your show. You're a wealth of knowledge, and you're my friend.
Thank you. You too, my friend.
Thank you.
Have a great day, everybody.
The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.